Last week I talked about the tax treatment of inheritances. One of the things I mentioned on there was inherited IRAs, but I really didn't go into detail. So this week I'm going to take a deeper dive into what that looks like. The rules around inherited retirement accounts can be really confusing and really complicated. So I'm going to break it down as simply as I can. Whenever you find out that you are the beneficiary of a retirement account, there are three things that you need to find out immediately. First, what type of account are we actually talking about here? Is it an inherited IRA? Is it a traditional IRA, a simple, a SEP, 401k, or a Roth IRA? There's some other options too, but those are the big ones that you'll see. Next up, you need to know what type of beneficiary are you. This one's going to be pretty obvious. Typically, you're either going to be a spouse or a non-spouse. And what type of beneficiary you are leads to different inheritance rules and different options that you'll have. Finally, you need to know the age of the deceased. Whoever you receive the account from, if they are over 72, which means that they had to have required minimum distributions, that's going to affect your options. So you need to get all three of these pieces of information together, then you can go to the next step. The next step is to reach out to the custodian. That's just whoever actually holds the accounts. That can be the 401k provider, that can be whoever actually holds the IRA. You know, we could be talking Charles Schwab, we could be talking Vanguard, Fidelity. There are a lot of different options out there. What you can do if you don't know where this is, you can, one, look at the statements if you have statements. You can call their employer if they're still employed. If you think they might have a 401k through their work, you can do that. Or you can always just Google and start looking to see if they have any statements that are laying around that would have that name on there. So first, you're going to reach out to that custodian. They're going to have a process in place for handling this. They're going to send you a bunch of paperwork. Usually it's about 20 pages, but don't worry, it doesn't all have to be filled out. And you're going to go through there and figure out what your next option is. Typically, you're going to have to open a inherited IRA account. No matter which option you're going for you're going to have an inherited IRA. You're also going to have to file the death certificate with that company. It's one of the things that they want to make sure that you are who you say you are, and that you really are the next of kin. So, obtain the paperwork, fill it out, and then file all the required paperwork. That's the first step. Next up, you need to start looking at the required minimum distribution. That's the amount that the government expects that you will take out each year, basically so the government gets paid. Because if it's a pre-tax account, whether it's a 401k or a traditional IRA, you got a tax break, or the person you're inheriting from got a tax break when they made the contribution. Fast forward however many years it's been, and as we all know, the government wants to get what they consider to be their cut. So you have to take money out, and then what's taken out has taxes counted against it because it is ordinary income. So that's the required minimum distribution. There are a couple different ways to calculate this. The rules actually changed in 2020. So I'm going to talk about this as if whoever passed away since 2020. The rules that happened before that, they're already in place for most people. They won't be grandfathered in. So that's where we'll jump to next. So let's talk about So let's talk about some specific situations. If your spouse passes away, you have two real options. The first is you can move their account to your name. You can retitle it in your name. You can treat it as if it has been yours the entire time. Your RMDs don't start until you hit 72. That's the simplest option. That's what you see the most often. But what you really need to think about is if you're under 59 and a half and you retitle that account, you're not going to be able to access it without penalties until you hit 59 and a half. I've seen this be an issue before because the spouses were, either there was a difference in ages there, or maybe one spouse died young. And so the younger spouse, or the spouse that was under 59 and a half, probably needed money to live on, and yet they couldn't access their retirement accounts without taking penalty because they immediately retitled it. Instead, the other option there is you can move it to an inherited account. An inherited IRA, in this case, would have to be moved out, would have to have RMDs over the course of 10 years. everything has to be taken out of that account within 10 years. And I'll go into more detail on that here in just a minute. But the benefit here is on those RMD amounts, there's no penalties. So the spouse that's under 59.5 can take out the money that they need without penalty. And then once they hit 59.5, then they can retitle it to their own name. So just something to be thinking about. If the beneficiary is a child, and by child I mean the child of the person who passed away, not necessarily a minor, you have one option, potentially two. So if you're an adult, essentially you need to have that money out within 10 years. Due to the changes that happened in 2020, now we're at the 10-year mark. What you can do here to minimize your taxes is you can look and say, in what years am I going to have low income years? Whether that is because you're going to have some time in between jobs, maybe you're still in school, maybe you're just going to have some years that you're not making as much. In those years, take out more of the IRA. That way you're taking it out at a lower tax rate. You don't want to put it off. You can put it off until the 10th year, but you don't want to do that. Because in that case, you have a lump sum, and at that point, that entire lump sum is going to be taxable income. That can really push you into a higher income tax bracket. I don't recommend that. The other thing that you can do is you can use this money to live on. And so if you have a 401k through work, maybe you're not already maxing out that 401k, you can take money out under the 10-year RMD schedule. That's the money that you live on to replace your income. And then you can actually take that income, put it back into your 401k. It ends up offsetting. As far as your cash flow, it's going to be the exact same. But you're getting a tax deduction because you're putting part of that income into your 401k. That can be a pretty big tax savings. The other option is if you're under 18, if you're still a minor, and you're a child beneficiary, then you can do what's called a stretch IRA. In this case, you're taking RMDs over the full course of your life. That drastically reduces the amount that you'll have to take out each year, and also lowers your taxes. So if you have the option, if you're an eligible beneficiary, I'm not going to get into that fully because it can be a long definition, but if you're a minor, just know that you can take stretch RMDs from your IRA. One more thing that I want to mention is that inherited IRAs cannot be mingled with other types of accounts. It's a question I get pretty often. I'll have a client that has both an inherited IRA and then a traditional or a Roth IRA that's their own. They say, hey Jeb, can I move my inherited money over to my regular money? The answer is no, and that's because your inherited IRA has the RMD requirement, your regular IRA doesn't. So never the twain shall meet. So pretty straightforward, but it's just something I want to mention. And finally, that's about it for inherited IRAs, or at least that's it on the primer. There's a whole lot to know here. It's really important stuff. And if you have an inherited IRA, the stakes are pretty high because the tax penalties aren't great. So if you have any questions, I definitely recommend reaching out to a professional. Shoot me a message, talk to your tax advisor. There are a lot of options out there.